Next, on January 1st, year 1, Billy Company signed a 3 years lease for office space, minded 3 years lease. The lease required monthly rent of $8,000 for the first year, $8,100 for the second year, $8,200 for the third year. Billy has the option to renew the lease for the fourth year at $8,300 per month. On January 1st, year 2, after 1 year is gone, January 1st, year 2, Billy permanently installed a new overhead lighting fixture at a cost of $2,000. How much amortization expense on this leasehold improvement should Billy record for year 2? Since this $2,000 that has been spent, it will give him benefit for the whole of year 2 and for the whole of year 3. So the benefit of this leasehold improvement should be amortized over the next 2 years by splitting it in equal parts. 1,000 amortization in year 2, 1,000 in year 3. So the question says what should be amortized in year 2? Just 1,000, and that makes B to be the correct option. Next. Dividend paid to the company shareholders under the US GAAP. The question is silent. Whenever the question is silent, that means you have to follow the US GAAP. Dividends paid to the company shareholders under the US GAAP, it is reported as a cash flow from financing activity. Look no further. Always under the US GAAP, dividends paid to our own shareholders, it is always as a financing activity. According to FASB, please note under the IFRS, dividends can either be reported as a part of your operating cash flows or as a financing cash flows. Whereas under the US GAAP, you must always report it as a financing cash flow. Okay, according to the FASB, that is the US GAAP, Financial Accounting Standard Board, remember this body issues US GAAP, whereas IASB, International Accounting Standard Board, this issues IFRS. According to FASB conceptual framework, which of the following would cause earnings to differ from comprehensive income? Please remember, comprehensive income has two components. One is income statement, other is the other comprehensive income, and they collectively make up what you call the statement of comprehensive income or just comprehensive income. Dividend declared but not paid. Dividend declared is not a component of income statement. It is not a component of OCI. This is totally an irrelevant option. None of these, income statement and OCI, they are both not affected. Realized gain on the sale of held to maturity debt security. This gain is reported as a part of income statement. Hence, income statement is a part of comprehensive income, so they both have the same impact. What we are looking for, something that affects income statement doesn't affect comprehensive income or vice versa. Again, which of the following would cause earnings to differ from comprehensive income? Your income statement will show something else and your comprehensive income will show something else. Means the item will only affect either income statement or OCI. That's the idea. Okay, now, unrealized holding loss from the available for sale debt security. Unrealized holding loss from available for sale debt security, we know it is reported as a loss in other comprehensive income. It will lower your other comprehensive income. In this case, this element will be reflected in comprehensive income but as a part of other comprehensive income. It will not affect your income statement. So income statement in this case and your comprehensive income, they won't tell you here. This is the situation where OCI is affected but income statement is not affected. This is the right option. What about the last one? Unrealized holding gain from the trading securities. Trading security affect your income statement. Gain will improve, loss will decrease, and as a part of comprehensive income, both are affected, right? So in this case, they will both be the same. Only under C, income statement and comprehensive income, they will disagree because item has affected only the comprehensive income through OCI, not income statement. Next. If a company reports a cash outflow of $95,000 in its investing activity section of the statement of cash flows, very simple question. Which of the following is most likely explanation? Very straightforward question. It's an investing outflow. So which of these is basically an investing outflow? Repayment of $95,000 long-term mortgage. Mortgage is being repaid. It's a financing outflow, negative. Purchase for $95,000 of a non-current asset, property, plant and equipment that will be used in operations. you have acquired a property, plant and equipment. It is an investing outflow, and this is the right option. This is an investing outflow. That's what we're looking for. What about C? Purchased for 95,000 inventory. This is operating outflow. What about D? Purchase on credit for 95,000, an insurance policy. It is a non-cash transaction. It has not resulted in any cash inflow or outflow. Totally irrelevant. So B is the right option. Next. Larrabee Incorporated, a US company, has the following deferred tax assets and liabilities. We have deferred tax asset 5,500, deferred tax asset 11,800. At the same time, we have a deferred tax liability 2,900, deferred tax liability 4,300. May be classified into current, non-current. What should we do under balance sheet? What are we going to report? First of all, you need to combine your assets. 5,500 plus 11,800 gives you 17,300, and your deferred tax liabilities combined gives you 29 and 4,300. That gives you 7,200. Since your deferred tax assets are more than your deferred tax liabilities by 17,300 and 7,200, the difference between these is 10,100. This is shown as a single item as a deferred tax, non-current deferred tax asset of 10,100. Please remember, under the US GAAP, deferred tax asset and deferred tax liabilities are netted. Deferred tax asset and deferred tax liabilities are netted, and they are either a non-current deferred tax asset or a non-current deferred tax liability. Remember, under the US GAAP, in the US financial reporting, there is no classification as current deferred tax asset or current deferred tax liability. Only non-current deferred tax asset and non-current deferred tax liability, right? So that would make A to be the correct option. A lessee enters into a 2-year lease for a truck with economic life of 10 years. The lessee intends to return the truck at the end of the lease for 2 years out of 10 years. So just 20% is the lease term, whereas the life is 10 years. The lessor and lessee have partnered on several leases together, and the lessor has ascertained that the collection of lease payment to be highly probable. Based on the fact described above, the lessor, I told you lessor accounting is not included, but at least you need to know the lessor can classify leases in 3 types. Lessor can have a finance lease if the owns criteria is met, I'm sure you know, or it's a short-term lease, or sorry, not short-term lease, sale type lease, and third is classification as operating lease. If owns criteria is not met, it can't be finance lease. Sale type lease also has to have one condition met in owns out of those 5 criteria, and if none of these is met, it's an operating lease. So since we do not have any criteria given, owns criteria, those 5 criteria, I hope you remember. So since this information is not given, what we can assume is that just 2 years out of 10 years are being covered, so it is an operating lease. It's not a sale type lease because it is just for 2 years out of 10 years life of the asset. And moreover, accounting for lessor is not included. I explicitly ask you to skip the questions involving accounting of lessor in the leasing. Next, a company paid cash of $12,000 on 1st of August, year 1. So when the cash was paid on 1st of August, this entry was made. Prepaid rent, 12,000, cash credit. And it is starting 1st of August, year 1, for 1 year's rent in advance, and recorded the following transaction. It means by the end of year 1, December 31st, how many months have gone by? August, September, October, November, December. 5 months are done. It means out of this 12,000, yearly rent means the rent is 1,000 per month. 5 months are gone. Now we must transfer some of the prepaid rent into rental expense. And what entry you're going to make? You're going to debit the rent expense to be charged on income statement, 5,000, and you're going to credit the prepaid rent now. Prepaid rent is now being transferred to the rent expense for the period. This is the entry you should pass. Rent expense debit and prepaid rent credit. So that would make debit rent expense and credit the prepaid rent. On January 1st, year 1, an entity that uses IFRS acquired equipment with a cost of $100,000, IFRS, and an estimated life of 20 years. The cost of equipment included $15,000 cost of a component that must be replaced every 5 years. Within this $100,000, there is another element. There is an inspection cost of $5,000. The equipment must be re-inspected after every 10 years at an additional cost of $5,000 per month. Please remember, under IFRS, an asset must be broken down to its components if the components costs are significant and the components have different lives. What you are going to do is a beautiful question. Out of this $100,000, you need to split. There are 3 different types of asset. First, 100 less 15 less 5. There is a plant or whatever this asset is, an equipment that has a cost of 80 and it will last how many years? 20 years. Then 15,000 represents another component, and this component will last how many years? 5 years. And then there is an inspection cost of $5,000, which is done after every 5 years. So this every 10 years. So it's 5,000 upon 10. So basically there are 3 components. This, and this. IFRS says that you must, mind the word, emphasis is on must. You must depreciate these assets separately. And what about the US GAAP? US GAAP does not require any such breakdown. If you want to break the asset down into components, fine. If you do not want to break down, no issue. GAAP has no such requirement. If you want to break down, you can. Otherwise, GAAP doesn't require. But IFRS says that asset must be broken down to its components if the components have significant value and they have different lives. So the question says, if the straight line depreciation is used, what is the depreciation expense for the year ended December 31st, year 1? So 80,000 by 20. So 4,000 for this type of asset. 1,500 upon 5, 3,000 for the second asset. And 5,000 by 10, 500 for the third asset. So if you add 4, 3, 7, 7,500, that makes D to be the correct option. D is the correct option. Next. Unless specifically restricted, if there is specific restriction on the common stock, if there is no such restriction, each share of common stock carries all of the following rights except the right to share proportionally in what? Common stock has share in operating profit? Yes, it does. Common share has a right to proportionally take part in voting for directors? Yes, it does. Common stock has a right to share proportionally the corporate assets when the business is bankrupt or it becomes liquidated? Yes. A, B, C are all correct, all right. Common stockholder, what it doesn't get? It doesn't get any proportional share in cumulative dividend, because this feature is specifically related to preferred stock. There are no cumulative dividends for the common stock. So this is not true, and hence our right option. Which of the following supplemental disclosures to the statement of cash flows is not required when the indirect method is used? I'm sure you remember indirect method starts from net income, make adjustments for working capital and other non-cash items, and then it will give you cash flow from operating activities. Right? So what is not required? Income taxes paid must be reported. It is required. Interest paid to be reported. It is required. Non-cash investing and financing activities must be given in the notes to the cash flow statement. It is required. What is not required is that when you are using indirect method itself is the reconciliation. Indirect method itself is the reconciliation between net income and cash flow from operating activities. So when you are using indirect method, you don't need to make any separate reconciliation. This reconciliation, it is required if you are using the direct method. I hope you would have read the theory of your cash flow statement. Under the direct method, US GAAP requires you to prepare a separate reconciliation of your net income to the cash flow from operating activities. This is specifically required when the direct method of preparing the cash flow statement is used. Next. Which of the following transactions would affect the retained earning but not the additional paid-in capital? Look for the transaction that affect retained earning but does not affect the additional paid-in capital. Let us just write in the column of form retained earning on one side and the additional paid-in capital. Remember, additional paid-in capital also called share premium or additional contributed capital or additional paid-in capital. Many terminologies you must be familiar with. Declaration of small stock dividend. Declaration of small stock dividend, in that case you debit retained earning with the market price of the stock issued, credit the common stock and credit the additional paid-in capital with the difference. We are looking for an option where one is checked and other is not checked. Look at this. Decrease in the value of an available for sale investment. If an available for sale investment, its value falls, this loss is reported as a part of other comprehensive income and it is not a component of retained earning. No, it's a part of equity but not retained earning. And does it affect other additional paid-in capital? No, it doesn't. What about C? Impairment of a long-term asset. When an asset is impaired, this impairment is reported as an expense or a loss in the income statement. So does it affect retained earning? Yes, it does. Does it affect the additional paid-in capital? Absolutely no. What about D? Purchase of treasury stock using the cost method. There are two methods of reporting treasury stock. I hope you would know. One is the cost method, in which we deduct the total amount. Let's say you paid $645,000 to acquire your own stock. This $645,000 as a whole is reported as a negative item in the statement of changes in equity. This is called the cost method of treating the treasury stock. Then what is the other method? Yes, Vikas, that's par method. In par method, what we do, we split the $645,000 into two parts. One, the common stock element, and other is the additional paid-in capital. Right? So when you purchase your own stock from the market and you're using the cost method, you have a single amount to be reported as a negative element in the statement of change in equity. So it doesn't affect the additional paid-in capital and it doesn't affect retained earning or income statement in any way. Right? Had we used the par method, then our additional paid-in capital would have been affected. So the option that looks perfectly fine is your option C.